All right, what is up, guys? It is Nick back here with another video. This is my third time recording this video, so please bear with me. The first two times I was saying I was going to compare EPD to SCHD and which one I thought was better to invest in, but both times I ended up talking about EPD for about 90% of the time. So I'm just going to kind of break down EPD and if I think it's worth investing in, short term, long term, and everything in between. So first off, I started investing into EPD about just over a year ago. I saw a podcast on it. It was We Study Billionaires. And I immediately fell in love with the stock. It was high dividends. It was a super safe stock. It's just basically an oil pipeline highway, basically, that gets paid for companies who run oil through the pipelines. So it's like a highway toll. You know, you have to go through the toll. You have to pay things like that, but it's for oil. So it's a meter, and how much oil gets sent through is how much they get paid. So they're very high cash flowing company. They pay very good dividends. And the kind of catch to it is that the taxes are completely different than normal stocks like SCHD. SCHD and a lot of other stocks basically are taxed where each year you get the dividends and you're just taxed for ordinary income. And then when you sell, you get taxed on the capital gains from those stocks. EPD, it's a little bit different. At the end of the year, if you have EPD and you don't sell any, you will get a K1 form. This just keeps track of how much you have invested, how much dividends you made, and how many shares you have, all the information. You don't have to pay any of the taxes yet. It just takes your information, and every single year they just kind of keep track. So what happens then is, let's say you invest $1,000. We're just going to keep numbers very simple because this kind of gets confusing, and I took a long time and a long chat with my friend ChatGPT here to try to figure out what this all meant and break it all down. So basically what happens is when you buy EPD, you get this K1 form at the end of the year and you don't pay taxes on it. But people were saying the taxes is like not worth it on it. I was like, what do you mean you don't pay taxes on it? So what happens is, let's say you invest $1,000 and you get $200 in dividends through that entire year. I'm gonna adjust this a little bit. So you get $200 in dividends for the entire year. And let's say the stock price didn't change whatsoever, just to keep math simple for a second. I will explain when it does go up in a second here. But so you earn $200 in dividends, the stock price doesn't change, your $1,000 is still $1,000, but you were paid out dividends $200. So what happens is your cost basis is what they call it. Your initial investment of $1,000 now looks like you put in $800 into the stock. So even though it's worth $1,000, they make it look like you entered with $800. So you're taxable on $200, but you're not going to be taxed on that as long as you don't sell the stocks. You will get taxed on it if, let's say, for a quick example, you don't reinvest your dividends. So after year one, your cost basis is $800. And then year two happens, you get paid another $200 in dividends. You take that, you go spend it, you put it in your savings, whatever you do, besides reinvest it. Then your cost basis goes down to $600. And then year three, year four, year five, $400, $200, and then it finally hits zero. Now, once it hits that zero mark, you will start to be taxed on long-term on those 200 dividends each year as long-term capital gains. So you will start having to pay taxes on those dividends. So let's say you reinvest those dividends and you don't invest any more money. So you invest $1,000 into EPD, you get paid $200 in dividends, and you reinvest those dividends. Instead of your cost basis going down to $800, your cost basis is now $1,200, but then it goes down to $1,000. So it moves up, but it still goes down $200. You're still taxable on those $200 technically if you were to sell at that point. But because you reinvested it, it moves your cost basis up as well. So as long as you keep reinvesting your dividends, it's going to keep that cost basis or prolong that cost basis from going to that 0 point where you would get taxed. And that's kind of the trap, I guess, for EPD. I wouldn't say it's like a bad trap, but it is something you do need to commit to prolong or to push off those taxes for paying those taxes. So what happens is, if as long as you continue to invest and reinvest those dividends and you keep your cost basis above 0, it will keep pushing back those taxes. And if you get to a point where you want to start living off your dividends and your cost basis is at $1 million, you can continue to keep those no matter if you reinvest your dividends or go and spend them at Target or wherever else, you're not going to get taxed until that cost basis hits 0. So let's say your cost basis is at like $1 million when you're 60 years old. You can spend $1 million and then you'll start getting taxed on it. But then you get to a point where it's like, okay, I'm still earning like a lot of dividends and you're just paying the tax on that, which I guess isn't the end of the world because your dividend income is still probably pretty high. So it's not going to matter, but it's definitely just going to push it back until your cost basis gets down to that 0 point. And as long as you don't sell those shares, you won't pay that complete tax on it, I'm pretty sure. I think that's how it is. But then the other thing to that is kind of I think is really cool about EPD is, let's say you get to a point where you pass away and you still have those shares. Whoever those shares get handed off to in your will, that cost basis is going to completely restart. So if you had $5 million invested and your cost basis had gone down to $1 million because you were taking the money out for your retirement and you were spending it, and that cost basis, let's say even the cost basis got down to like $50,000. Like after a year or two, you're gonna have to start paying taxes. When you pass away and those shares get handed off to the next person that is in your will, the cost basis is gonna reset back up to that 5 million. So they can either take out those dividends and spend them up to that 5 million point, or they can keep reinvesting to grow that cost basis mark up until they pass them on to the next person. So, and when your share price grows on the stock, if EPD goes from $30 to $40 and you have 1 million shares, it's going to go from $3 million to $4 million. It's not going to stay at $3 million. When you pass those shares on into your will, that price will jump from that original $3 million cost basis to $4 million. So that's another thing that is super cool about EPD. I see it as kind of just a generational stock. It's something that you want to like continue to invest in and commit to it fully, because the benefits from it are really generational benefits. For most stocks like SCHD, you're going to be paying taxes as you go, which isn't the end of the world, but it definitely takes a bit of a hit for a while, because a lot of until that snowball effect really kicks in for stocks like SCHD and other dividend stocks, you're going to be paying like quite a bit of dividends. But once that snowball effect does kick in and your income is skyrocketing, those taxes are obviously going to matter less. So I will continue to invest in SCHD, even though it is kind of weird because the dividend payment is half of what EPD is per quarter. So it does kind of feel like almost a waste for me to invest in SCHD right now. I feel like I will invest a lot more because their dividend growth is like 10 to 12%, which theoretically, if they keep that up forever, they should pass EPD and dividend payments in like 5 or 6 years. It'll, I think if EPD keeps growing their dividends at their rate, it'll be a little bit longer. So maybe 8 to 10 years, 7 years, 8 years, somewhere around there. But for me right now, especially because both of the stocks don't change that much, they're around the same price, and they both haven't really been growing that much. So it makes more sense for me, I feel like, to just invest in EPD because the dividends are higher paying. Once SCHD continues to grow their dividends each year, especially if they keep up that 12% growth every single year, which I don't know is going to be true, because when I did the chart for SCHD in 30 years and reinvesting dividends and everything, it obviously outruns EPD by a mile. But I looked at the dividends per share, and I forgot how many years it was. It was like almost 20 years. You're going to be getting $6 a share from SCHD, which I think is highly unrealistic. So I feel like SCHD would eventually slow down their dividend growth to maybe, I don't know, 8%, 6%. As long as they're a bit above that 3%, I feel like they're 100% fine. EPD grows at like 4%, which is just above inflation, which is fine. But I see that being more realistic in 30 years, is continue to grow their dividend payments at 4% rather than 12% every year. For SCHD, that snowballs pretty quick, and I honestly just don't think that's something that they will be doing in 30 years, because once that annual dividend price is over $6, they're going to be growing their dividend 60 cents a year. Is honestly, I don't know. With inflation and everything, I have no idea when and how the growth of the market and everything is going to be, whatever. I just don't see it being realistic, but I'm not counting it out. I just am not going to bet the farm on them continuing that 10-12% dividend growth every single year for 30 years. My goal for SCHD and EPD and any dividend stocks, anyone's goal, this is not financial advice, the smart thing for dividend stocks is to just never sell them and let that compounding effect happen. So it shouldn't be something to scare you off for EPD, the taxes and everything. It's honestly a really good way you could avoid taxes completely if you keep them until you die and hand the shares off to your kids or whoever's in your will. And I think too, once you because in 20 years, if I don't invest any money, my annual dividend income would be like $3,400. But let me do some math real quick. Okay, so I calculated that if the stock grows over 30 years, 5%, and then, which is pretty conservative for a stock like EPD, I feel like that is pretty close to what it averagely grows at. And then investing an extra $100 a month, I would never hit that cost basis point in 30 years. And after doing that, the dividend income it's honestly only $17,000 a year. Okay, so I calculated that over 30 years, if EPD grows at 5%, and then you invest $500 a month into EPD, after 30 years, your annual dividend income would be just over $70,000. And in those 30 years, continue to invest. And wait, do I have drip on? Oh, that's no drip. That's gonna be it for this video, guys. If you have any questions, comments, concerns, whatever, if you have either of these stocks and have comments, or just let me know how many shares you have, what your plans are. Again, none of this is financial advice. This is just what I'm doing, how I see the future kind of shaking out, and kind of what I'm doing with my investments. I also do kind of dabble a little bit with some growth stocks. I just recently posted a video about that, and I'm starting to kind of dip my feet into that a little bit more, but I'm not going to fully commit to it. I want to try to keep them both, I don't know, maybe 70% dividends and then 30% of kind of growth stocks. Just because I've been on the sidelines for growth stocks for so long, and I was like, I just need to get into some of them. I'm young. I shouldn't, every time I look up dividend videos, it's all about, oh, it's old people. And I'm like, but I'm thinking Warren Buffett compounding effect over 10, 20, 30 years. So I feel like I'm super young for being an old dividend investor, nice and safe. My portfolio has been flat for the whole 3 years I've been investing, but I have a dividend chart. Believe it or not, I'm a geek here. My portfolio has been 100% flat. I've literally to date, it is flat, but I've earned $643 in dividends, and this year will be my biggest year. I think I'll get to, let's see, I'm gonna add an extra $260. So I'll be at almost $1,000 at the end of this year. It is starting to snowball. I'll put a picture up of my chart too, actually, and everything. But obviously the beginning is the hardest. It's the slowest. But over time, and the more time I have way more time than 40, 50-year-olds. So it will snowball to a lot more in the future. But that's me this video, guys. Thank you so much for watching. Catch you next video. Peace.